to put some numbers in perspective, what we have in the graphs are the GDP per capita in the US, in the Euro area, in Japan and China. And what we see is that we worry about a discrepancy between the Eurozone and the US, but it has started a long time ago. It's not recent. And it's been going on. And on the right-hand side, you get a global view of the percentage, the importance of each economy in the whole world. And although China per capita is still very much behind the US and Europe, you see that China now is a dominant economy, close to 20% of global GDP in purchasing power terms. And you also see that the Euro area has lost, in the last 35 years, has lost half of its importance, okay? It used to be close to 20% of the world, and now it's about 10%, okay? So that's what's going on globally. We worry about labor productivity in Europe. The fact that we grow less, it means that it's essentially the amount of productivity that's less, that's growing less relative to the US. Things are moving up, but not as fast. There is a big problem across the world, in Japan, in Europe, in the US, in China, which is the population is growing old, and the dependency ratio is increasing. That's important. We should always keep in our minds. And when it comes to growth, automatically we think of investment. And when we compare the US with Europe, and you look at the ratio of investment to GDP, it's the same in Europe and in the US. It's much less than in China. China is declining now. That we want it to happen. But on the right-hand side, what the graph shows is that we should worry about the quality of investment. And because now everything is digitalized and the world's becoming digital, and that's where demand is, that's where value added is, we see that the Euro area sort of has flattened out in terms of how much it invests. The US is moving much, much faster. Now, a lot of talk, and I guess in your mind, is about what about the governments? Can they really invest, or are they over-indebted? And I hear this sometimes in Europe. In reality is, if you look at Europe, the debt to GDP ratio is much less than the US. I would worry about the US, in fact, on the fiscal side. Japan is, of course, the worst, but it's trying to do a better job. And China, its debt has gone up. So the fiscal issue is less of a concern for me. It may be for specific countries in Europe, like France, Belgium, or Italy, but it's not a big problem. And the big problem in Europe, and I'll sort of stick to this transparency, is what the Draghi and the Letta reports mentioned. It's the supply side. Yeah. We need supply side economics in Europe because we are a fragmented union. We are not, and we have a problem of scale. And we are fragmented in the products and service markets. And now we're thinking about perhaps creating a 29th regime so to avoid and have similar regulations everywhere. We worry about DG competition. The DG Comp is thinking of companies large in a specific small country, and it's not thinking of Europe. So it has all these rules that prevent companies to grow big and tackle the whole European market. And we should be thinking of industrial policy European-wide, especially because the US is doing this, and China. Okay, so we have fragmented products and services market. Both Letta and Draghi made a big deal about it. We don't have a capital and banking union, and we want to create it. In fact, we need to boost savings. We need to boost domestic savings somehow. We have a fragmented labor market. People cannot move so easily and carry their pension with them so they can work everywhere. And of course, if you look at the union as a whole, we have external security problems. We realize them because of Trump. Can we address these issues? I have here a graph that says 2 years after the Draghi report, only 10% of the suggestions have been implemented. They were implemented a lot when it comes to critical raw materials, when it comes to transport and energy, but everywhere else we're behind. Of course, there's a political problem. We can always discuss about this. We need to have, perhaps the veto should be something that should become something of the past. And I have some graphs, especially that support what the Draghi report mentions. For example, this is a graph that shows that when it comes to banking union, we're becoming more and more closer together up until the great financial crisis. Like when you look at the banks, close to about half of their assets were outside the home country. But after 2007, 2008, 2009, this has declined. Again, now only about a quarter of the asset side is outside. So when it comes to labor mobility and the fact that and the savings and labor and the savings and loan union, you see the big difference between. It's evident in how much the American worker and the American citizen saves for his pension. The total assets in pension funds in the US are 160% of GDP, and in the euro area is only less than 30%. So we need to do something. We need to go away from the pay-as-you-go systems, create IRA accounts, keep the money in Europe. The money, we definitely have a lot of money. I'm going fast. We have a lot of money because we have general account surpluses, but the money goes to the US. And if you need to raise money, a company goes to the US to raise money. And when it comes to defense, we're aware of the problem, we spend more on defense, and we need to do more.
Okay, thank you. Apologies for rushing you there, but we have a short session and a lot to get through. It's a truism that you can't solve a problem until you know what the problem is.
Exactly.
I think we've had an excellent, succinct diagnosis of the problem there. Is there anything you would add or change to what you've just seen?
Yes, of course. Thank you very much for being here. And I doubt whether the diagnosis that you present and that is going around here for the whole morning is the right diagnosis. So everybody says we need a savings investment union, we have a problem with the capital market union. I think this is not the key problem of Europe. First of all, we have a capital market union. You can invest your money freely all over in Europe. Where's the problem? And you just showed a chart where you can see that we had a lot of banking integration in the years 2004, 5, 6, 7. So if banks want to lend, they can do it. And the problem was that there was too much bank lending, 2007, 2008. No, that was the crisis in Europe. So of course you can talk about this capital markets union, but I don't think that it will fundamentally change the situation in Europe, especially if you look at the measures that's being discussed to complete this capital markets union. It's very small things, a little bit more insolvency, common insolvency regime, maybe integrating capital market supervision. But I think this is not the problem. It's really not the problem. What is the problem in Europe? Well, it's the problem that we have huge problems with our technology. We are in a middle technology trap. That's a problem. And the question is, how can we change that? How can we transform our economies to deal with this middle technology trap? And of course, the middle technology trap means that we have nothing to offer in the area of digital platforms. We have almost nothing. And that's where the US are very strong. On the other hand, so far we could survive with a lack of a digital competence because we produce very nice things that we could, manufacturing things, cars and that we could easily sell in China. But now things have turned around and the Chinese are building better cars than German cars. And so we have neither the digital competence and we have lost our dominance in manufacturing. And here we are. And how do we get out of it? Not by completing the savings union or something like this. We need a very comprehensive industrial strategy. I think that's what you need. And because if you look to what they did in China, their success is a result of a very comprehensive industrial policy since many, many years. And what do you need for a successful industrial strategy? You need money. Yeah? It has to be financed. And in China, they financed it. Yeah? Not by turning the savings of their citizens into something, but with a system of government-guided funds. Funds that finance small enterprises, and the size of the government-guided funds in China is $1.5 trillion. And so that, of course, you have here this Hellenic Fund, and it looks nice and good. But if we have the European Investment Bank and all that stuff, but it's peanuts. The size of these funds is negligible. And so what we would really need is to find out how we can enhance the mechanism, how we can first define key strategic areas for Europe. I think the EU does this to some degree. Yeah? But we also need to mobilize the money then to finance it. If you look at you have shown that, how much do we invest in artificial intelligence? It's nothing compared to what's going on in the US. But shall we wait until we have completed the savings union? No. So we have to find out ways how to finance it. And that's something, of course, which was also addressed this morning. We would need joint financing facilities for the European Union, Eurobonds, which is a terrible word for Germans, to finance joint efforts in new technologies, in energy grids, in infrastructure, and all that. And so it's very nice to talk about these savings, but forget it. It leads you in the wrong direction, because the key problem is what you need is a clear industrial strategy, and you need funds, and funds that must come from the government. Sorry, they don't come from the savers. The European savers don't want it. They want to keep their money with banks. They want to keep it safe. They save a lot. In fact, they save more than the US. Private household savings in the US are negligible. They don't save almost nothing. Okay, so some stimulation maybe for the discussion.
Okay, excellent. Thanks very much. So you say this money's got to come from governments, from European governments. Where do European governments lay their hands on $1.5 trillion?
Well, so if you look at the joint debt to GDP ratio of the EU, is much lower than in the US, much lower than in Japan. So I'm not afraid of this. And of course, people say the capital markets, they won't give the money. But as a capital market, would I feel happy with investing in US government bonds with this crazy precedent? Is this really still a safe asset? I'm still surprised that markets have not yet reacted to this. What can you do more than destroy the reputation of safe assets? That's what all Trump is doing all the time. And so I think if the EU shows that the money is invested in future-oriented projects, I think the capital markets will finance it.
Okay. The quality of investment is key in industrial policy. And in China, clearly it's been central to China's growth story, its ability to mobilize funds and to direct them from the center to projects that they want to support. Does Europe, given its fragmentation, but also given its political pluralism, does it have the same ability to deploy funding and, frankly, to fail from time to time that China has?
Well, I think industrial policy is always about failure. I think industrial policy is investing in areas that are too risky for private investors. I think that's the role of industrial policy. If you have safe investments, the private sector does it, but industrial policy is investing in areas that are too risky for private investors. That's the logic of this. But of course, the problem starts in my own country. We have now all kinds of reforms, but in Germany, the notion that we need industrial policy is completely absent. We have an economics minister who thinks this is wrong. We shouldn't do it. So that's a disaster, and that's something which is very, very problematic for Europe, that we, at the heart of of Europe and the strongest kind of powerhouse, that we lack any strategy for how to transform our industry. You can see a very disruptive process in our automotive sector. It's really very severe, and the economics minister believes in Ludwig Erhard and in Hayek and all that stuff. So I cannot give you very very positive news from Germany. Sorry.
Okay. Does Europe have the institutional capacity to, again, I'm sorry, I'm going to stick with Peter for a second. I'll come back to you in a moment. But does Europe have the institutional capacity to design and implement and follow through a centralized industrial policy that works for the continent as a whole?
Well, I think the EU is doing a lot, so I have lots of strategies. I think in principle the EU knows that, but I don't think they have the funds. And of course, there's also, of course, the willingness of the member states to cooperate. But if they don't, if we do not cooperate, I think we'll be lost. So I think we would need a joint European AI strategy. And if each country does it by itself, then the individual sums are much too low, and it's already very late. But without a joint approach, we won't succeed.
Okay. UCAS, this is clearly not aligned with your diagnosis. It seems to me, but
I
please.
don't think he said something contradictory. I mean, the problem in Europe is fragmentation in many fronts.
Yeah.
The savings and investment union is a part of it. Perhaps in Peter's view, it's not the first priority, but it definitely is good if it happens.
Oh, of course.
Yeah. But I agree that there should be an industrial policy, but to have an industrial policy, you have to have a unified political decision-making, and we're not there yet. And that's
This
a big
is what
problem.
strikes me as a key feature of your should, would, nice to have plan. That fundamentally, perhaps the coordination isn't there, and coordination is absolutely central to successful industrial policy.
No, you're right, but one has to address the problem.
Yeah.
Whether you can solve it is a different question, but one has to see this is the problem, and of course it should start in Germany, where, as I said, the notion that industrial policy is a good thing is not very strong.
Yeah. But when you see the world and you see the China, which is it's sort of autocratic society, I mean, there's one decision maker.
Yeah.
Europe, you have 27 countries, different sources of power, different decision making. That's our problem. To have an industrial policy and to be able to adjust to the changing environment, it's very difficult.
Yeah.
It's good to do it, but it's very difficult. And we know now that the issue is the AI and digitalization, and that's where the global economy is. We need to move there, but we're behind. None of the big tech companies are in Europe. They're all American.
Yeah.
And Chinese.
Well, let's pursue that a little and go to the sort of second part of our question, which is, can Europe keep up? I mean, you've both given your diagnoses. In both cases, you have clarity around what you would like to see done in terms of policy. What are the odds of either of those prescriptions being followed by Europe?
Europe usually moves because of a crisis. That's the experience.
But this is an odd situation because the crisis.
Now the crisis is Trump. Trump all of a sudden said, I will no longer defend you. So now Europeans thought, gee, we have to spend money on our defense. Can they grab the opportunity and have a common European defense strategy, or each country will invest separately wherever they like? That's a challenge.
Right. I'd like to, sorry.
But I would say the crisis is already there. So it's not that we have to wait for the crisis. At least for Germany, the situation is really difficult, and you can see that all the automotive companies are dismissing people, closing factories, and so for Germany, the crisis is there. In Germany, for the last 7 years, we had no growth. 7 years of stagnation. And in this overall stagnation, the only positive element is government consumption, while at the same time, private investment went down by 10%. So I would say in Germany, we have this crisis, and yeah. So we don't have to wait for it.
Yeah.
Maybe it's not yet visible.
Part of the German crisis, for example, is the fact that we don't have a unified energy market.
Yeah.
If we had a unified energy market, we wouldn't depend on Russians so much.
Yeah,
Okay.
of course.
And if we had a unified Europe, we didn't have to depend on China to sell products. And if we had a unified savings and capital union, we didn't have to go to the US to be able to attract funding if we are a small company, we want to go big.
Right.
I mean, so we need, all of these things all come down to fragmentation. And the solution is political solution. The political solution is frustrated by the veto principle. We need to have a new way of solving our problems. Perhaps a coalition of willing for various issues, but somehow we need to find ways out of the veto.
Okay. At the risk of depressing our audience completely, I want to, I think we've already sort of started well down that path, but I want to take us a little bit further. I think Europe is facing a crisis. People, it's in the language that we use about our descriptions of policy prescriptions for Europe. But this is a dynamic crisis in the sense that it's not standing still. So it's not a situation where you have a challenge and you have to do something about it. That challenge is changing under our feet. Particularly the technology issue that you've spoken about. The longer it takes Europe to catch up or to keep up or to do something on the technology front, the further behind it falls in a dynamic way. So what do we need to do to give Europe a fighting chance of being a player in this tripartite world that we'd like to imagine we live in on the technology
When
front?
it comes to technology, yes, we're behind the top things that happen on AI in China and the US. But I think we haven't lost the game because we can think of applications of technology, and that's what we're good at. We have smart people in Europe. If we invest in innovation, in technology, we can think of ways of creating new products. We don't need to have the top research, but we can do manufacturing, so to speak.
Right. And your thoughts?
Yeah, we must see that, of course, we have smart people and have also a lot of research. But the problem is how to get the large scales, and that's, of course, a fragmentation. And the problem is, if you look at innovative products like semiconductors, there's not very much that we have to offer. That all comes from China and Asia. In Germany, we have now at least some cluster in Dresden, where we are really good at producing semiconductors. And all the products related to renewable energies, they all come from China. And maybe the only chance is that we revert the flows that we ask Chinese companies to produce in Europe. I think that's something that's happening, and maybe we have to.
I think that's.
It's not a good. It's not. But in the end, if they invest here, they bring the knowledge to Europe. And honestly speaking, I think Europeans are not able to build battery factories. We don't know how to do it. We need the Chinese that do it, and maybe accept this and say, okay, if you invest here, no.
Yeah,
the
Chinese companies now cannot invest in China. The return is low, so they're looking to actually go outside.
Yeah.